Good afternoon, ladies and gentlemen. Now we should continue with the currency derivatives. So, last time I talked about that how can we forecast or can have at least expectations about currency exchange rates. So today let's continue because still we have to talk about that how can we define currency derivatives, what are the ways of these tools when we can at least manage foreign exchange rate risk. And then during the next video, so here we will talk about, or I will talk about that how can we manage risk actually. So what are the risk management strategies? So right now we were just able to see that in the first video that it is possible to suffer harm from the exchange rate movements. Today I will show you that what are the available products to manage risk, and then we will build them up together to see that how can we make a coherent strategy from these elements. Yeah, but today we are talking about currency derivatives. So first of all, we have the most basic currency futures contract. So it means that this contract is first of all legally binding. Yeah, obviously. That's why it's a contract. Agreement to buy or sell a standardized asset on a specific date. So in a future date, let's say in 2020 September, or during a specific month. Yesterday when I showed you the future prices, you were able to see that I was talking about 2020 deliveries. So that's the reason that mostly they are listed on in months. So we have expiring date for December, for January, for March, usually in quarters. And what is really important that it's made on futures exchange. And this is really important because in this case it's market based pricing what is happening there. Actually we can have forward contracts, but forward contracts are made with banks, so it's not for retail clients, it's for wholesale market. So if you have a trade account actually and sufficient money to have all the collaterals what is needed, so margins to put there to open a position, then we can be there. But for forward contract, it's for the bigger players. Usually forward prices are really close to future prices. Just it's for the big enterprises, so they can smaller margins and so on. So it's always standardized. So if you are looking for so it's not only for exchange rates for currencies, but also they are for commodities. So that's why we can have different oil types, for example, Brent or VTI type oils, because it can have different sulfur content and other trace minerals can be different. Or, for example, in the case of wet, and actually it's much better to see that what kind of. So if you are using stoku.com, we can have, in Polish it's towary, so futures. And actually here we can see that what kind of products are available. So in the case of energy, we can see Brent, CO2, VTI oil, also palm oil, and so on and so on. So we can find here many different natural gas, for example, coal, gasoline, even uranium, ethanol, and also for different metals we can find here data, and and grains. Cocoa. Oh, there are two different cocoas. Nice. And also orange juice, for example. So mostly what we can standardize at some levels, then even milk, what we can find here. So and mostly these contracts are running for a defined expiring date when they are ending and over. So mostly when we are using this kind of data, then they are making it spot. So because in this case we can utilize it for research and analytic purposes. Yeah, oil price is cheap now. Yeah, so we can see that, yeah, sometimes it can end with physical delivery. It depends on the stock market. Sometimes you just have to close down the contract, and you have to define the quality, the quantity, and the location. Okay, for exchange rates, it's way more easier because you can just give the exchange rate. So it's way easier than physically delivering several thousand tons of crude oil. And actually, the meaning of a futures market was that if you are trading with commodities, you need time for delivery. Because, for example, right now you just put the seed in the ground, and in this case, if you are able to sell the finished product, so the after harvest, all the seeds, the new seeds on the market, then you can hedge your position in this case. So you can stabilize your prices. You are not the subject of further market volatility. Yeah. And also we can calculate the hedge ratio, which defines the amount of futures to sell against long currency position to efficiency hedge market risk. So we are taking value at risk, so amount of position, and the notional values to the contractual unit multiplied with the contract price, and after that we can see that what is our hedge ratio. But what is really important that when we have to main or open position, then first of all we have to have margins. So it means that we have to have a non-interest bearing deposit at the financial service provider, because even if our partner, because we are all on this market listed thing, so we are always making contracts with another partner, not with the stock market. And even if this partner goes to default, then the stock market or the clearing house behind the stock market will step in. So that's why we are not running any kind of partner risk in this case. But as a reason, when we are initiating the position, we have to have the initial margin. So it means that some percentage of the contract should be accounted on this deposit. So actually, it can change completely that how much percentage should be there, but we can see that it can be 3 to 12% of the future contract, or sometimes even half of the face value to have or to initiate the position. And after that, depending on the volatility of the market, the maintenance margin can be or should be maintained. So maybe they will ask us later on that we should put more money to cover our position. And if you are not able to meet the margin call, then our position will be reduced or liquidated. So in this case it will end. Also exit strategies. So we can say offsetting or liquidating the position means that right now we are realizing all the profits and losses, and it means that but we don't want to have physical or cash delivery of the assets. So it means that we are taking out at the last day an opposite and equal transaction to neutralize the trade, and after that we will see the loss or profit on the trade. Rollover means that actually we are opening a new position for the next month, and in this case we can just continue. And also if we are not offsetting or rolling our position to against the expiration, then we have to go for settlement, and in this case we are obliged to deliver, and physical or cash settlement can be done. Actually, what it means that you can use forward markets to have speculative position if you don't have actually the physical goods. Just you have expectations about that, oh, prices can increase or decrease. Actually, it provides liquidity to the market. So without speculative positions, it would be really hard to find demand for supply, so to connect the two sides of the market. On the other hand, if you are in long position, so you have the seeds or oil, or you will need this Czech runas at the end of the month, then you will hedge your position. So you want to get rid of the exchange rate risk or the risk of fluctuation of the price and so on. So in this case, it means that you are in a long position and you need someone to care of. So that's why it's always ridiculous when people are crying about that, oh my gosh, speculation is bad. Come on, without speculators there would be no market at all. So deal with it. Yeah, and how spot market and future prices are related to each other. Actually, it's connected through the ratio of the foreign exchange rates, foreign interest rate and domestic interest rate. The ratio will define that. Actually, if you are putting this amount of money into the bank right now, then what kind of money can be earned until the future position. And the trick is that yeah, just this interest rate is variable interest rate, so actually it means that we have also expectations about future interest rates in this case. So it's really funny to calculate back that if you are able to see the market expectations about future prices for different expiry, you are able to see the spot price, and after that you can see that what is the anticipated interest rate in this position. Yeah. Then forward contract, yeah, I mentioned already that it's made with banks and it's for bigger positions. So if you already have some nice relation with your bank, then they will allow you to have this, and maybe margins can be smaller, and other fees can be smaller. So it's for big enterprises.